Now, let's talk about importance of capital budgeting decisions. Then we can say this. So you write, you say investment decisions. Hope you can hear me. Can you hear me?
Yes, I can. Continue. I can hear you.
Thank you. So we say investment decisions must be carefully planned. Investment decisions must be carefully planned for the following reasons. Investment decisions must be carefully planned for the following reasons. Number one, such decisions involve huge amount of cash outflow. Such decisions involve huge amount of cash outflow, which may lead to heavy losses. Which may lead to heavy losses in case of failure. So which may lead to heavy losses in case of failure. So zikifail, losses zitakuwa mingi, so lazima tuziplanie vizuri. Number two, the decisions are highly irreversible. The decisions are highly irreversible or can only be reversed at a substantial loss. The decisions are highly irreversible or can only be reversed at a substantial loss. So if you decide to make an investment decision, like let me give a good example. I want to invest in matatu industry. I buy this matatu at maybe 7 million. I go and modify it, maybe naweka hizo ma TV nifanye nini hapo ndani, then naiweka kwa barabara. Like after 1 week, I discover that, wow, this is not my business. Then I decide to dispose of that matatu. I know if I take that matatu back to the market, I'll not get back even my 7 million. That's the time you can be told, take 3 million or leave it. So the decisions are highly irreversible. And if you have to reverse, you'll reverse it at a very huge loss. So that's why we must carefully plan for it. Number three, they affect all departments of the farm. They affect all departments of the farm. Hence, may affect the general operations. May affect the general operations negatively. May affect general operations of the farm negatively if unsuccessful. So many people are involved in them. So in case they fail, they'll affect many departments of the company. Another one you say that is number 4. they may negatively affect staff morale. They may negatively affect staff's morale in case of failure. In case of failure, due to high level of engagement, during implementation. Another one, peana ya mwisho. Peana ya mwisho, we say, they may negatively affect the firm's cash flows. They may negatively affect the firm's cash flows, stroke liquidity position, in case of failure. In case of failure, due to huge investment cost involved. Due to huge investment costs involved. So I didn't just spend 10,000 in investing in that project's millions and millions. So zisiporudisha cash flows already zitakuwa zimeacha big gap. Then you can skip one line, then you say, available projects are evaluated. Available projects are evaluated by undertaking a cost-benefit analysis. Using different investment appraisal techniques. Including so you have the examples of investment appraisal techniques. Number A, we have non-discounted cash flow techniques. Hizi pia zinaitwa traditional techniques. So under that, we have the first one. So examples of the non-discounted cash flow techniques. We have the first one, accounting rate of return. ARR. The second one, we have payback period. So nizo mbili for the non-discounted. Alafu we have the second one, which are discounted cash flow techniques, also known as modern techniques. So under the modern techniques, we have number 1, net present value. That is a NPV. We have internal rate of return. IRR. We have discounted payback period. Discounted payback period. We have profitability. Profitability index, that is PI. And we have number 5, modified internal rate of return. That is MIR. So those are the techniques that we can use to carry out a cost-benefit analysis to advise on whether to undertake the project or not. And in all that, whether we are talking about save for number 1, whether you're talking about the payback period, hizi zingine zote. Out of the 6, we must know how to calculate the components of cash flows. So let's have a subtopic on components of cash flows. Components of cash flows. So components of cash flows, number 1, we have initial outlay. That is IO. So initial outlay, basically, these are the cash flows of year 0. Let me try to explain what I'm talking about here, first of all. Now, I want to invest in a project. I'll go back to my matatu. I want to invest in a matatu project. The first thing I must think about is, how do I get money to invest in this matatu? So I must first of all buy the matatu before it can start giving me any profits. So the initial outlay is actually the initial cost of investing in that project. That's why I call it year 0. Before it starts bringing in anything, at the beginning of the life of that project, that is year 0, I must invest in it. So I can have shillings.
I cannot see your screen down there.
Sorry?
I cannot see your screen down there.
That's okay?
Yes. That's okay.
Great. So the initial outlay, we talk about cost of the new machine. So I buy the new machine. Then after buying the new machine, we add any incidental costs.
What are those incidental costs?
Like now, when we talked about the matatu that we buy, we talked about kuweka hiyo, putting in the TVs, putting in the seat belts, putting in maybe the speed governors, kuifanya ikuwe nganya, you know, the language that you people normally use, or them. Okay. The cost that we have to incur before the machine becomes productive. I'll give examples. Installation. installation cost, we can have modification costs, we can have import duty. Kama nimeimport hiyo machine, lazima nilipe import duty. Can even have transport to site, ama freight charges, the cost of transportation. So those are basically in simple terms, the pre-production costs, the costs before the machine becomes productive, pre-production costs. When you love politicians so much and you want him to come and commission, the project shall have commissioning costs. Those ones. Testing costs, all costs incurred before the project becomes productive. Then of course, the total of that tunaiongeza hapa. And now that gives us total cost of the new machine. The total cost of the new machine. Now, after getting the total cost of the new machine, sometimes you're confronted with two scenarios. Scenario ya kwanza ni, we are evaluating the project for the first time. We didn't have this project before. And the second scenario, we had an existing project and we want to replace it with a new one. Ni kama trade in. So if it's a project you're evaluating for the first time, we shall not have an old project. But if it's a replacement decision, that means as I bring in the new project, I do away with the old project. I'm replacing. Ni kama trade in. Vile nanunua gari mpya, nauza gari mzee. So I want us to kill the two birds with one stone. We shall just separate them. So here we can less disposal value of old machine. Kama tuko na replacement decision, tuta less the old machine. I'll explain it. Then you also talk about tax on gain, stroke, loss on disposal. Are we selling the old machine at a profit or at a loss? So to get the tax on gain or loss, we ask ourselves about the disposal value of old machine. Then we less NBV. NBV stands for the net book what? The net book value of old machine. So the difference gives us, we get the tax on gain stroke loss. Tax on gain stroke loss. So it will be a gain if the difference is a positive, or a loss if the difference is a negative. You multiply by the tax rate, you bring it this side either as a positive or as a negative. So I want you to highlight these. Let me use a different color. Maybe you can just indicate hapa mbele, even if you can use kale kakitu just to appreciate kuwa hii story iko hapa. It will only affect us if you're undertaking a replacement decision. If you're not undertaking a replacement decision, then that part haitakuwa. And of course, hapo chini itakuwa na net cost of new machine. So I highlight mpaka hapa. So that bit will only affect us if you're undertaking a replacement decision. If it's not a replacement decision, then hii part ya hapa haitakuwa because there is no old machine. This one is about, we have an existing machine and maybe it has become outdated. You want to bring in a new one to replace the old one. Then after all that, tunaongeza working capital. Working capital, which is current assets minus current liabilities. And now that gives us the initial outlay. So the concept of current assets and current liabilities are very just as simple as this. Tuna appreciate kuwa, if you're undertaking if we are undertaking a project, for instance, if I'm doing manufacturing, I must buy the stock. As I buy the new machine, I must also buy the stock so that it can be able to be productive, so that I can be able to produce and sell in the first year. I buy the machine. That machine cannot work for me if I don't buy the stock. Stock is a current asset. I'm buying the stock on credit. I'll have the current liabilities, the creditors. So the investment in working capital should be part of my initial outlay. Great. Then component number 2, penye it makes sense unauliza. We have annual net cash flows. So I invested in the project. The project has become successful. I've already installed it. I've bought the stock of raw materials. I'm ready to start producing. So after producing now, in year 1, let's assume the project has maybe 3 years. So I shall have year 1, year 2, and year 3. So I can assume the project has the 3 years, sorry. So you have shillings, and shillings. So the annual net cash flows, just like any other income statement, you start with sales. In year 1 umepata sales zako, year 2 uko na sales zako, year 3 uko na sales zako. Sales will less what? You can less variable costs. Kama umepewa cost of sales ni sawa, you less the expenses. So less the expenses. Kama variable cost, kama umepewa sales minus variable cost, we get what? We get contribution. So we get contribution. So get contribution for each of the years. So after the contribution, we less fixed costs. Kama tuko nazo. And of course, that will give us pre-tax cash flows. Pre-tax cash flows, also known as earnings before depreciation and tax. So that is among the fixed cost depreciation haikuangi ndani. So you have the earnings before depreciation and tax. So there we go. So tukishapata the EBDT, I want us to use the shortcut, we less tax. We less tax, kama tuko nayo. So we less our tax there. Then we add an animal called depreciation tax shield, also known as DTS. DTS. And DTS is not difficult. It is simply our depreciation you multiply by tax rate. So depreciation tax shield is simply depreciation multiplied by the tax rate. So unaongeza hapo the DTS. And whatever you get is your net cash flows. That is our second component. Okay, I hope it's okay.
Yes, it is.
Finally, number 3, terminal cash flows. Terminal cash flows. So I invest in the project in year 0. The project runs for 3 years, year 1, year 2, year 3. And now the project is coming to an end. After 3 years, so this one, I can call this one the cash flows of year 3. The project is coming to an end. So here I look at the scrap value of new project. Scrap value of new project. I less scrap value of old project. And I'll only less this one if it was a replacement decision. So again, this one, ni kama ni replacement. Anytime you're talking about old, it only affects a replacement decision. If I didn't replace it, then there's nothing to, you don't have an old project. So it only affects me if I'm carrying out a replacement decision. Then of course, after that, I also come and add working capital. So the working capital I invested in Hapa, this one here, I must always remember to recover it as a terminal cash flow. So the working capital that is here, and the concept behind it is very simple. I'll explain it just right away. Let me first of all conclude that one becomes our terminal cash flows. Now, the assumption is always that when I invest in when I buy the raw materials in year 0, those raw materials will have to serve me, will have to serve that project for as long as the project is in existence. So in year 0, I'll be able to buy what I'll produce and sell in year 1. After 1 year, I'll also buy what I'll produce and sell in year 2. In year 3, pia lazima ninunue the raw materials to be produced and sold. But because I'll not be there in year 4, ile pesa ningetumia kuinvest kwa raw materials in year 4, I'm going to save it. So that's why I bring it here. So the working capital I invested in as an initial outlay, I come and recover it as a terminal cash flow. Great. Unless kama kuna swali, can we have one? So you can check the last sitting, April 2023 FM, question 1, part B. Great. So we are told that SIPO Limited is evaluating an investment project which requires the importation of a new machine at a cost of 3.7 million. So when you look at that statement, hatujaambiwa mahali popote kwa they are replacing. It's a new machine altogether. There's no old machine being replaced. So importation of the new machine at a cost of 3.7 million. The machine has a useful life of 6 years and a salvage value of 1 million. So itumike kwa miaka 6, salvage value milioni 1. The following additional cost would be incurred in relation to the machine: modification cost, import duty, installation cost, freight charges. I believe those are the incidental costs that we talked about. So the incidental costs. We continue. Great. The machine is expected to increase the company's annual cash flows, that is before tax, as shown below. So examiner amekuwa generous, akatupa hapa kwa annual cash flows. He has done for us the sales, aka less variable cost, aka less fixed costs, amanzia hapa before tax annual cash flows. So simply need to less tax and we add our DTS. So the machine will increase the company's annual cash flows as shown below, year 1 paka year 6. The machine is to be fully depreciated over its useful life on straight line basis, straight line method. Tax is 30%, cost of capital is 10%. The maximum acceptable payback period for the company of all capital projects is 4 years. So they want us to get the total initial outlay. The total initial outlay. So let's see. Let's see how to get the total initial outlay. We go back to our Excel. So that is April 2023, question 1B. So we start with the initial outlay. Can have it in thousands of shillings. So we have the cost of machine, cost of the new machine, and the new machine will cost how much? 3.7 million, right? Then we add incidental costs. For incidental cost, we have modification. Modification cost is 1,000. We have import duty. I can see 900. We have installation cost. 375. Then we have freight charges. $225. So you have that summation. So the incidental cost at 2,500. So that gives us total cost of new machine. So which gives us 62, if I'm not wrong. 6,200. Now, remember, we did not invest, we are not carrying out a replacement. We are not carrying out a replacement decision, so there is no old machine here. So whatever we highlighted, all this information, we won't use it because there's no old machine to be replaced. Looking at that question again, we did not invest in any working capital. It's not there. There's no working capital. I'm trying to look at the question. There's no working capital anywhere. So in simple terms, this one will represent our initial outlay. I can just put here for the sake of remembering, working capital is not there. So we have our initial outlay, which is 6,200. That is our first 2 marks of that question. Then number 2, so number 2, annual net cash flows. They want us to get annual net cash flows. So you can have the year. It had 6 years. So I have year 1, year 2, year 3, year 4, year 5, and year 6. I have them in thousands of shillings. So there we go. Great. So examiner ametufanyia kila kitu mpaka kwa earnings before depreciation and tax. So we start from our earnings before depreciation and tax. That's why alituambia the machine is expected to increase the company's annual cash flows. That is before tax. That is the annual cash flows before tax, and of course before depreciation also. In year 1 mpaka year 6. Year 1 I think 1,760. 1760 in year 1, year 2, 1360, year 3, 1050, year 4, 900, 840, and 750. So we less tax. Na tax wamesema ni 30%. So 30% of 1760. So 0.3 times this. So you have that one. So here equals to 0.3 times EBDT. So allow me to drag. Great. So that is our tax. So we are lessing our tax. Then we get, let me put it as a negative. Ndio ikuwe negative. So we have, then we add what? We add the DTS. So depreciation on straight line basis, cost minus salvage value over the useful life. The total cost of the machine, kona hapa juu, 6,200. Incidental cost forms part of the cost of the machine. So that is 6,200 minus, walitupea scrap value. Naona kwa swali scrap value ni 1,000. 1,000. Then we divide everything. Miaka yake ni 6. So divide by 6. And everything we multiply by what? 30%. So that is 5,200 divided by 6. 5,200 divided by 6 times 0.3. I think 260.
260.
And it's 260. Straight line basis, depreciation is fixed for each of the years. Great. So we have our annual net cash flows. We have our annual net cash flows. So the summation. So there we go. Then after that, they want us to get the payback period. Maybe we can just have another working number 3. For terminal cash flows, we need it. Terminal cash flows. So for the terminal cash flows, I need scrap value of the new machine. The scrap value of the new machine tuliona ilikuwa 1,000. I did not have the old machine, so there is no scrap value of the old machine. I did not invest in any working capital, so I don't need even to put it there. So my scrap value only remains for the new machine as my terminal cash flows. And that is it. That is it. So if we can take like, to get the payback period, we'll need to do some little notes. So payback period. Probably we can pick it up from there next week, because we need to write some notes on payback period before we can do this question. But in simple terms, to pay back is to recover. So the period that it takes for the company to recover its cost. Out of this amount that it's generating, how long does it take for this company to pay back the 6,200? Let's talk about it next week. Unless kama kuna swali.